Now, before we talk about the valuation landscape, I just wanted to get your opinion. Why do we need to learn about valuation as risk professionals? I mean, we understand valuation of derivative is something that the front office folks would do, right? Because they negotiate with the clients and come up with a price, a model price. So typically, the valuation is a job of front office quant desks. However, as far as risk management is concerned, the knowledge of valuation is still important. First and foremost, we talk about sensitivities all the time. Okay, in market risk, especially, all your life you will be dealing with sensitivities. So we know these are called Greeks, option Greeks, but pretty much you can find sensitivities for any kind of instrument, starting with the simpler ones, linear instrument, forwards, futures, or the complicated ones, options, exotics, right? Now, why are sensitivities important for market risk? Well, if you look at the risk calculation, be it value at risk or expected shortfall, or even profit and loss attribution or back testing, right? All these calculations involve sensitivities. In the FRTV document, if you look at the standardized approach, they have given the risk aggregation formula. How do you go about aggregating risk within the bucket and then across the bucket to arrive at the final capital charge for market risk for the entire trading book? Everything they have given. Okay, how the aggregation routine they have given, correlations they have given, risk weights they have given, right? The only thing that you need to do as banks is to calculate sensitivities and plug in to that aggregation routine, right? So that's why you need to know sensitivities. And trust me, in market risk, if you're appearing for an interview, you will be grilled on sensitivities. You should be knowing sensitivities like the back of your hand. Okay, they might very well, give you a exotic a pricing function that you have never seen before, and then they might ask you to find out the different sensitivities, find out delta, find out gamma on the spot in the paper. Okay, I have seen this is the trend these days. They are asking derive the things in the interview itself. So you need to know sensitivities and Taylor series expansion. These are the critical tools for a market risk professional. Okay. Now, okay, we understand we need sensitivities. Fine. Why do we need valuation? Well, the answer is sensitivities is model dependent. Sensitivities are model dependent. What kind of valuation model do you have? Is it an analytical closed form valuation model like Black-Scholes? Is it the binomial tree? Is it Monte Carlo simulation? Is it finite difference? Is it Fourier transform? Is it a quadrature? There are tons of valuation models, and the sensitivities very much depend on your valuation model. That's the reason why we need to know about valuation models. Okay, that's point one. Point number two is the valuations that we are taught in popular certifications. I don't want to name them, but you can pretty much guess the kind of certifications that I'm talking about. The popular certifications that we have, we do valuation in a very very kiddish way. We take toy examples, and most often than not, you find value of a derivative today. The questions are always like this. You are given, let's say, the stock price, the interest rate, the time to expiry, the volatility. Find the value of the call option today. Find the value of the put option today. If you are given the spot term structure, find the value of a forward today. Find the value of FRA. Find the value of interest rate swap today. But you need to do more. Why you need to do more? Well, if you talk about counterparty credit risk, okay, look at the picture on the right hand side. If you talk about counterparty credit risk, we need to actually calculate the price of the derivative at every single point from today to expiry. And you end up getting an exposure profile. So the one that you're seeing is the exposure profile for an interest rate swap, IRS. Okay. And if you look at this picture, there are two main outputs. One is EE, which is expected exposure, and the other one is PFE, potential future exposure. EE goes into your CVA calculation, and potential future exposure goes into your EAD calculation for your default risk. Okay. And essentially, so if it's a 10-year swap, calculating value today, I mean, anyways, you find out the fixed rate in such a way that the value of the swap is zero today. But given the term structure, you can definitely find value of IRS today at time t equal to 0. But that is not enough. You need the valuation at every single time point from now all the way up to expiry. And then you get these profiles. What is the average exposure? That is EE. And PFE is sort of a worst case exposure. Okay, something like value at risk. You need those data points. Okay, so that's for risk management, CCR, counterparty credit risk. Now the question is, how do you build it? You have to know the theory behind stochastic process, so you can simulate the underlier, and you can get the various price distribution at every single point from now till future. Okay, so these are the primary two reasons why you need to know valuation in today's world. And just because you are appearing for a market risk interview doesn't mean that they will not ask you about value, right? Today everybody expects everything, right? And it wouldn't be harmful to know about valuation. Valuation sits at the heart of quantitative finance, and everything kind of goes from there. Okay, any questions? Did you understand the two main reasons why we need to know our valuation? Clear, everyone? Any questions? Cool. Okay, let's proceed. I just have one more slide. So this is the first slide. Then I have another slide, and that's it. Then I'll please hang tight till the end of the presentation. I have some really, really good stuff for all of you. So let's look at the valuation landscape. Now, I call it the derivative valuation maze, really. It's actually a jungle if you think about it. When I started my financial career, so I have close to 12 years of experience in risk and capital markets. Initially, you'll find being bombarded with a lot of these different financial tools and techniques and calculations, derivations, theory, all of these things. It took me close to 5 to 7 years to actually get a good grasp of the entire landscape. And I do have a mathematical engineering background, so I can imagine if you are from non-mathematical background, let's say if you're from commerce background or something else, this might take a whole lifetime for you to figure out the whole derivative valuation landscape. I'm not joking, honestly. So it's been 5 years or 7 years worth of ransacking different financial engineering books after books after books, blogs, articles, and experimenting every day with Excel, Python, and all these things, right? And a lot of soul searching. Okay, it's not just what you read or what you do, you have to introspect also, right? To internalize all these things. So yeah, it's a very difficult journey. However, I have tried to paint the entire landscape in just one page. Okay, so that you get the big picture. Obviously, mastering each and every topic takes time, right? But at least if you have the big picture in your head, it will be extremely easy for you to, navigate this maze, the derivative valuation maze. So that's the whole idea. So let's slowly climb through different components and go step by step. Okay. All right, let's proceed. First and foremost, you need to know about stochastic processes. And it's a irony of fate, I would say, that popular certifications today skip this particular section. You just learn a little bit about the stochastic processes. And is there maths involved? Yes, there is maths, there is calculus, there is probability, there is a special type of calculus called Ito calculus that you need to know. But conveniently, all these popular programs skip this entire section. And believe me, this is the first starting point. This is the first thing that you need to master, stochastic processes. There are very, very advanced concepts. We don't need to deal with everything. At least at a bare minimum, you need to know how does the stochastic differential equation looks like. Okay, why is a stochastic process? There is a drift component and there is a diffusion component. And then you see this dw. What is dw? Dw is called as a Brownian motion increment, or you can call it a Wiener process. It sounds scary, but trust me, you just need 4 to 5 hours investment to understand the big ideas of this particular topic, stochastic process and stochastic calculus. It's not scary. If you know calculus, there are a couple of tweaks and exceptions that you need to learn, and that's it. You will be able to understand stochastic calculus. I have no idea why this is avoided so much. I mean, I discovered everything on my own, right? Nobody told me, as I mentioned, right? But I am giving you everything here today so that your journey at least is easier. You know where to look at and how to go about it. Your first and foremost focus would be to at least know some facts and master some of the derivations of stochastic processes. Okay, so when I say when we talk about topics inside of stochastic process, it will be what is an SDE, how to solve it. Okay, what is the solution of the process looks like. Taylor series is the single most important tool in market risk. So if you enroll in this course, you will become a master of Taylor series, because that's what I use on every single lecture. And trust me, with Taylor series, you can understand FRTB equations very easily. In fact, I have derived FRTB equations using Taylor series. Everywhere you'll find Taylor series, in my lectures at least. If you understand Taylor series, you don't need Ito's lemma. You hear about Ito's lemma. Sounds complicated. It's not complicated. If you understand Taylor series, you don't need Ito's lemma. You can derive it yourself. So the whole idea is going from SDE to the solution, and from solution going back to SDE. You go from SDE using a Ito integral process, and then from solution, you go back to SDE using Ito's lemma or Taylor series. That's it. To do this confidently, you need to know a few properties of Brownian motion. What is Brownian motion? What is the expectation? How do you calculate the variance, covariance? And there are few properties. I'll show you. The idea of Markov and martingale, these are important. And then a few exercises that you need to do on Ito calculus. That's it. Okay. Again, I said 4 to 5 hours investment, not more than that. But you need to know stochastic processes. There is no escaping stochastic process. All right. So that's step number 1. Step number 2 is to model the underlier. In all of these derivative landscape, what are derivatives? Derivatives are functions of the underlier. If the underlier moves, the derivative prices move. As simple as that. Now, you need to fit one of these different named stochastic processes that I've highlighted to the underlier. You have to assume that the underlier, in our case, we are talking on, let's say we're talking on equity. So stock price, S, that's my underlier. And that gives rises to many of these derivatives, forwards, futures, and we have options, different, all kinds of exotics, right? So if this is the underlier S, then you need to choose which stochastic process I need to use to model S. So here are some of the very popular, stochastic processes. One is arithmetic Brownian motion. We have geometric Brownian motion. Then we have constant elasticity of variance, EEV models, and Ornstein-Uhlenbach or OU processes. And there are many more. This is not the end of it. We have, jump models, variance gamma models, other things. But these are at least the most popular ones. Now, let me ask you, which model do you think is normally used? Which stochastic process is normally used to model a stock price? All of you, please participate. Okay, everybody says GBM. Perfect. Geometric Brownian motion. Yes, that's the one that is used. But within geometric Brownian motion, you need to know a lot of things. How do you, go from the SDE to the solution? Number one. Okay. Number two, if I give you this geometric Brownian motion, if I am an interviewer, I'll ask this question. I'll give you this geometric Brownian motion. I'll ask you, give me the distribution of the stock price after 6 months. Give me the distribution of log of stock price after 6 months. Give me the distribution of forward price after 6 months. These are the questions I'll ask. And it is absolutely critical for you to understand these and calculate everything seamlessly. Okay. So that's the kind of clarity you need. All right. Okay, as you can see on the right hand side, we have what are the things you need to know. SDE, how the SDE looks like. This is the SDE. These are the SDEs. Okay, stochastic differential equations. Why do we say differential? Because you see D everywhere. DS means change in S. Okay, is equal to some drift. Drift has this DT component. This is deterministic, and then we have the random component or the diffusion component that has this DW. Now DW is the Brownian motion that I mentioned. This is the fundamental currency of modeling randomness. In all of stochastic process, we use DW. DW is just a normal distribution. That's all. A normal distribution. Because we need some randomness in our model, right? Stock price today is, let's say, $100. Tomorrow, we don't know what it will be, but tomorrow it's a random variable. How do we model that? Well, why don't you use the most popular random distribution, normal distribution? That's all. We use normal distribution to model. Not as is, there are some tweaks. You add some drift, you scale it to suit your mean and variance needs. Okay. All right. Yeah. So you need to know SD solution, the transition density. Everybody says stock prices diffuse log normally. That transition density is log normal for GBM, right? You need to be absolutely confident. If on the spot, if somebody asks you, give me the transition density, you should be able to easily answer that question. How do you calculate expectation variance at different time points? Then parameter estimation. How do you go about fitting this mu and sigma? These are the parameters, right? How do you find the values of these two? That's parameter estimation. And then we have simulation. Okay, Monte Carlo simulation. I will show you examples of all of these. Not everything, but at least some of the important topics in this slide today. So you can understand what are the different resources that we provide in this course. Okay, so understanding stochastic process theory, how to deal with SDEs and solutions in general. How do you go about handling the Brownian motion? And how do you go about calculating different moments and yeah, just going back and forth between these two. That's number one. Number two, use a named or a popular stochastic process to model the underlier. Step number two. All right. Step number three. What is step number three? Step number three is to understand the pricing theory, derivative pricing theory. On this, yes, the popular certification programs do a good, decent job explaining the theory. There are so much more. If you are interested in quant finance, there are a lot of other theoretical ideas. But the two main fundamental ideas in derivative pricing theory is based on, so actually it's one fundamental idea. It's called no arbitrage. No arbitrage. That's the single most important idea of derivative pricing. Okay, so there are two ways that you can go about pricing derivatives. One is called replicating portfolio. So in replicating portfolio, essentially you look at one option as a combination of bond and stock. Okay, bond and stock. Option partly behaves like a stock because obviously it depends on the underlier, right? So option partly behaves as the stock and partly behaves as the bond because there is always a time value of money. In any financial instrument, you have some time value of money because there is a cash flow happening at expiry in future. So you need to find the present value. So at every single point in time, we can represent an option as a combination of stock and bond. what is the proportion you choose in which you need to mix them together? That proportion keeps changing every time. So that's called as a replicating portfolio strategy. Okay, you synthesize the option artificially by combining stocks and bonds. And then we have another idea called as delta hedging strategy. These are not like radically different. They are the same, but the approach is a little bit different. In delta hedging strategy, what we do is we will consider a portfolio by combining the option, and we'll short some amount of the stock so that overall portfolio is risk-free. Okay, option behaves like the stock. So long on option and short on, let's say, the underlier. You find out the right amount of units of the underlier such that the overall portfolio is risk-free. If it is risk-free, then it should behave like the bond. It should grow at a risk-free rate. So that's another idea. Both are similar ideas, but the approaches are a little bit different. Okay, so that's another idea. The third approach is risk-neutral valuation, which is the most popular approach. Essentially, you take expectation under risk-neutral density. Value of a derivative is the expectation under the risk-neutral density. Okay, and there is a lot of theory behind it, how we arrive at that particular formula. Okay, so yeah, I mean, you have some idea of this. This is popular derivative pricing theory. Once you understand this theory, there are really two main pricing equations that come out of this argument. Okay, the first one is called the PDE, partial differential equation. This V that you see is the value of the derivative. And other things are, have the natural meaning. So T is time, R is risk-free rate, S is it should be capital S. The underlier, sigma is the volatility of the underlier. And yeah, that's pretty much it. So you get a differential equation, a partial differential equation. I have derived it in the class. So from delta hedging strategy, you can arrive at this equation. It's not difficult. There are 5 or 6 steps, that's all. But this is the partial differential equation that changed the whole world. Literally. Back in 1973. Who gave us this partial differential equation? Let me ask you this. This differential equation came in 1973, and the folks who came up with it won the Nobel Prize, not immediately, but I think in 1995 or 7 or something like that. Yeah, Black-Scholes, yes, correct. So this was the Nobel Prize winning equation. All right. So that's one pricing equation. The other equation that comes out of this argument is the one that I mentioned, expectation under risk-neutral density. So value of a derivative is the expectation of discounted payoff in the bracket. The one thing that you have to consider is this Q. Q stands for risk-neutral density. You cannot assume the stock price grows at a rate mu. Mu is the real world growth rate or real world drift. So if you take historical stock price data and you take the returns, calculate the mu, the average. That is not something you can use. Okay, you have to modify this equation. Instead of mu, we need to use R. See, in the PDE also, there is no, where is mu? There is no mu. There is sigma, but there is no mu. From the delta hedging strategy, it's so beautiful. Actually, when you derive using delta hedging strategy approach, the mu actually cancels out. It drops off completely. So you end up with this equation that is devoid of mu. You only have R. Similarly, there are other arguments out of which you can derive this particular equation. There is something called as fundamental theorem of asset pricing. Okay. So with that, we arrive at this framework, which is expectation under risk neutral density. As I mentioned, it is the expectation, which is average of this guy. This is discounted payoff, but the density for expectation, you need density, right? It's an integral. So the density that you need to calculate the expectation, that density will come from this GBM, because the stock price follows GBM. Remember, with this, you can always calculate the transition density. The only caveat is this Q means use risk neutral growth rate, not real world growth rate. So instead of mu, we replace basically mu by R. That's the only difference. And then you take expectation. Okay. So these are the two fundamental pricing equations that govern the derivative valuation landscape. All right. Okay. This is a probabilistic idea because you are calculating expectations. So you need values and densities. And the other one, PDE, there is no randomness, nothing. It's just a differential equation. Physicists deal with differential equations their whole life. Okay. We have lots and lots of differential equation in physics. Starting with the simplest one, which is Newton's second law, right? Force is equal to rate of change of momentum. Simple differential equation. That's an ordinary differential equation. This is a partial differential equation because you're taking partial derivatives everywhere. Now, partial differential equations are abundant in physics. If you look at waves or heat, the way heat propagates through materials, or if you look at fluid mechanics, you'll find these differential equations. Now, this is a simple differential equation, honestly. It looks complicated, but compared to the ones that are used in physics, this is actually very easy. The kind of differential equations that aerospace engineers use are much more complicated, nonlinear differential equations everywhere. Okay, with suitable, substitutions, this equation reduces to a one-dimensional heat equation. Now, this is extra information I'm giving you, just that, you have some context. So yeah, this is a partial differential equation. So there are two different fundamental pricing equations. Now, next step. By the way, interviewers today are asking you to derive this equation in front of them. So from delta hedging strategy to this PDE, you need to know how to derive this equation. All right. And yeah, so don't take this lightly, okay? Black-Scholes PDE is the most fundamental PDE that governs the derivative pricing equation. All right, so next step. The next step is to solve. Essentially, you got the equation, then solve for V. We want V, right? V is the value of the derivative, so solve for V. For solution, we have actually four different machines. The first one, I call them pricing machinery. The first one is called analytical solution. And it is exactly how it sounds. So basically, you have an equation, integrate and solve. That's how you solve differential equations, right? There are differential equations, you integrate on both sides, you find the solution. But this integration is no joke, okay? If you integrate this equation to arrive at option price, it's around 5 pages long. There are multiple substitutions, a lot of different properties, green function, and all those, heavy lifting that you need to do. It's 5 pages. I don't recommend you to take a look at it unless you have, you have an engineering background and you love calculus. Then you feel free to look at it. But this is already done. So why do you need to look at it? Look at it only once so that, you can see the different steps if you wish to. If you don't, absolutely fine. Don't worry about it because we already know the solution. Black-Scholes option pricing formula. That's the solution they have given us. Okay. So that's analytical. Analytical means closed form. It's available as a formula. Just use that formula and integrate to arrive at that formula. Okay. So that's one approach. The other method is when you have a differential equation, you can use something called as finite difference grid. Now, I'll show you examples of some of these important ideas. Okay. So we have something called as finite difference grid. What we do essentially is these are continuous. Okay. whenever you are using calculus, it means that the variables are continuous. Only then you can take derivative, right? But we replace these continuous maths with discrete points. So we look at various points in space-time grid. Here we have no space, we have stock price. So stock price is like space and time is the time. So in that stock price versus time space, we look at various different points. You can see there is a small diagram here. And then at each and every point, we start marching down the grid using this equation. But these are in continuous. So we replace these using finite differences. You can calculate derivatives using finite differences. So I have some examples I'll show you. There are, I don't know if you have heard, if you know this, but let's say, for example, if you want to calculate delta, there are three methods: forward delta, backward delta, center delta. Okay. Similarly, I think these formulas are there in the other courses that we do. How do you find gamma or convexity? Using finite differences. So basically, you shock the underlier by a little bit and you see the change in price. The change in price by change in the underlier is your approximation for the sensitivity. That's all. Okay. So we use those definitions, the finite, through finite difference, we use those definitions to replace this equation. And then we have a starting point. The starting point is actually on the extreme right. On the extreme right, which represents expiry, we know the price. We know the price of the option at expiry. It is max of, if it's a call option, then it is max of S minus K comma 0. And then we start marching down the grid from right to left with the help of this equation. But all of these derivatives are replaced by finite differences. And that's all. I'll show you an example later on. I'm just giving a high-level idea at this point. But this is a very well-known, established method in physics or engineering, for that matter, to solve partial differential equations using numerical methods. This is a numerical method, okay? Because we are using finite differences. All right. So basically, those are the two treatments you can do with this differential equation. You solve it analytically or you use finite difference. Now, there are two other methods. The one is binomial tree, and I'm 100% sure all of you are pretty familiar with binomial tree. So that uses the second idea. We calculate the price using expectation, and we ensure that in the tree, the underlier actually grows at the risk-free rate. Question to you: how do we ensure that in the binomial tree, the underlier grows at risk-free rate? Remember, the second pricing formula totally depends on an expectation of the discounted payoff, but the density at which the underlier grows is the risk-neutral density, right? In binomial tree, when we construct the tree, we ensure that the stock price grows at risk-free rate. How do we ensure that? Please participate, you know this. And these are the questions that will come in the interview. Sachin says Q. Yes, that's correct. So we use risk-neutral probabilities. We alter the probabilities. Okay. We alter the up and down movement probabilities in such a way that the overall growth rate is risk-free rate. Okay. We play with the probabilities. That's what we do. All right. So those are called as risk-neutral probabilities. That will enforce risk-neutral growth, or growth rate equal to R, essentially. Okay. So that's binomial tree. Now, the last one is Monte Carlo simulation. we use the same pricing function, which is expectation under risk neutral growth. And as I mentioned, in Monte Carlo, what you need to do is take this equation, which is the GBM, find the solution of S using Ito integral, you find the solution of S. Then you simulate various paths of S. What are the different values that S can take by using random numbers. Essentially, you will be drawing drawing a lot of normal randoms, because as I mentioned, W, the Wiener process, follows normal distribution. So you'll draw lots and lots of different values of W, and then you have various paths of the stock price. Once you generate lots and lots of paths of the stock price, and then finally you use this formula. Okay, this will depend on, so if it's a European call option or put option, the value of the European call option today will depend on how the final payoff values look like in the Monte Carlo simulation. At the very end, during expiry, what are the different payoffs? You can calculate payoffs because you have the values of S, different values of S that you have simulated, and payoff formula For call option, it is max of S minus K, 0. You put that here and then discount it and find the average. And by using R instead of mu, we are already enforcing risk neutral growth rate. So that's all. That's all there is. Okay. So when it comes to valuation, you have to choose which of these 4 models you are using. Excuse me. Because your sensitivity calculation also will depend on the model that you are using, valuation model. All right. So last step, after you have this pricing machinery, what do? You value derivatives. That's all. So the last step is valuation and Greeks. So as I said, valuation and sensitivities go hand in hand. They are both model dependent. Depending on the type of valuation engine you use, you will be able to calculate sensitivities. It will be different if you use a different valuation engine. If the engine is good, they should be close. All right. Now, as I mentioned here, you can see we have different types of instruments: forwards, futures, which are linear instruments. Then we have options, we have swaps, and a whole bunch of other exotics. I didn't have space in my slide. And on this, you see different valuation methods that we talked about. The 4 different valuation machinery, right? Analytical, finite difference methods, binomial tree methods, Monte Carlo. Using any of these valuation method, you can find the price of the derivative. You can also calculate all the sensitivities that you need. Okay. Now, yeah, that's all. Now we'll look at some examples. But before I proceed, any questions on understanding this landscape? Yeah, so essentially, this is the derivative maze in one page, right? I'll pause here for any questions on any of these steps. No questions? Either is it going above the head, or you guys are understanding everything? Not sure which one it is, but if you can tell me, I'll understand. Avishek has a question: which is the best pricing machinery in industry? Absolutely no way to answer that. Because depending on the situation, you adopt a different machinery. Right? So I'll give you some more flavor. If there are, okay, analytical formulas are the most convenient because you have a formula. Just use the formula. Even if the formula is half a page long, that is still preferred because it is the fastest and the most accurate, right? Unfortunately, we don't have analytical formulas for a lot of these exotics. For European call option, put option, yes, Black-Scholes is there. Forward futures, yes, analytical formulas are there, but If you go to exotics, like let's say barrier option or other kinds of compound option or other things, there are no analytical formulas. There are approximate analytical formulas, but then there is a trade-off. Do you want to sacrifice accuracy for speed? That's the question. Okay. So this is the fastest and most accurate, but if there are approximations, then there is a problem. Okay. Finite difference grid are very fast because everything is deterministic. You don't have to generate any random number. These are very fast and also very accurate. The only problem is if the derivative depends on multiple underliers. Beyond 3 underliers, it becomes problematic. The equations become really, really large and there is a maintenance headache. It's very easy to commit errors. Okay. So FD grid is brilliant if you have 1 or 2 underliers, but beyond that, it becomes a nightmare. But you'll get speed and accuracy. In fact, there is another advantage. Okay, so I'm talking about valuation. I'll talk about Greeks after this. Okay. Next, binomial tree. This is everybody's cup of tea. Extremely easy to understand. That's why this is taught in all the different courses. But it is very much restricted. Restricted in the sense, you only have 2 possibilities of the stock price movement. At any point, it can only either go up or go down. That is not the true picture. Okay. It severely limits your ability to find out, prices or even Greeks at different points that are not part of the tree. Because at a given point, you can only move up or down by a factor that is U and D, if you remember. And those factors are tightly coupled with sigma, the volatility. There is nothing in between. So that severely limits my flexibility when I'm talking on binomial tree. However, this is still used in industry for, because of its simplicity and depends on a use case. Another advantage of binomial tree is that it can price American options easily, right? But you need to start using lots and lots of steps to, have the desired accuracy in binomial tree. The last one is Monte Carlo. This is the most flexible method that ever exists in valuation landscape. You can model any derivative you want. And it's one set of same mechanical procedure. Generate random numbers. If they are correlated, then generate correlated random numbers using Cholesky decomposition. Simulate stock price. 1, 2, 3, 5, how many you have, doesn't matter. And then you have all the different simulated paths. You can price any exotic you want because you have price points at every single time point. So you can price them. Only drawback is computational cost. Generating random numbers is no joke, actually. I mean, in a complicated portfolio that a bank will have in real life, generating random numbers or simulating random paths of all the underliers together, taking into account correlation and everything, that costs significantly. Okay, so you need infrastructure to support Monte Carlo, but it is the most flexible. Okay, you start favoring Monte Carlo more than FD grid if your number of variables is larger. So if you have like 5 different underliers, go for Monte Carlo. Okay, and it will be slower. Monte Carlo is the slowest of all. And you need many, many more paths to have accurate results because it has its own estimation error. Monte Carlo estimator has its own variance. So because it's based on random draws. So that's why. Okay, so that's in a nutshell. Now, talking about Greeks, let's talk about Greeks. If it's an analytical formula, how do you calculate Greeks? How do you calculate delta, vega, gamma, theta? How do you calculate? If there is an analytical formula. Question to all of you. If you're using an analytical formula for pricing options, for example, Black-Scholes, how do you calculate Greeks? Answer is partial derivative, exactly. You differentiate. You have the function in front of you. You know how to take derivatives, right? Take derivative. That's correct. If you have FD grid, so for all of these, actually, for the rest, you use finite difference to calculate the different sensitivities. In FD grid, the other advantage that this FD grid gives us is that the sensitivities are right there in front of you in the grid. Okay, since you have the whole grid in stocks, price and time space, you can easily calculate the delta, gamma, and theta sensitivities. Because for finite difference, you need stock price in neighboring points, which you already have, a stock price and option price. Just take the difference and find the ratio. That's all. Everything is there out in front of you. So that's one more advantage of FD grid. Okay. Similarly, in binomial tree, you do have sort of like a FD grid. I mean, different points at different times, you have different value of the options in front of a tree. But it has limitations because you don't have the flexibility to find out the sensitivity at any given stock price. Okay, because it only models two possibilities, up and down. So what you do in the middle. So to calculate delta or gamma using binomial tree, you have to just reconstruct the tree again by shocking the underlier and then find out the difference. I will show you everything, don't worry. And then in Monte Carlo, it's the same story. You price the derivative using Monte Carlo simulation with the initial stock price, let's say $100. What is the delta? How do you calculate? Well, shock the underlier, make that 100 as 101. Redo the entire Monte Carlo simulation again, find out the new option price, and then take the finite difference. So new option price minus old option price divided by change in stock price. That's the delta. The only thing that you have to remember in Monte Carlo is you have to use the same random numbers. For any Greek's calculation in Monte Carlo, when you are computing the old price versus the new price, use the same set of random numbers. Do not use different random numbers. That's it. So that's the Monte Carlo is the costliest one. Takes time, it's slow. Okay, so that wraps up the discussion around different pricing schemes and what are their advantages versus disadvantages. Now let's go to, let's say, geometric Brownian motion. In GBM, as I mentioned, right, you need to know about different transition densities, how to calculate expectation, how to calculate variance, how to simulate, right? So this is the evolution of stock price. Okay, this is the solution. Remember that in GBM, you saw the SDE. This is the solution. It comes out of Ito integral. And then using this, you can simulate the stock price. Okay, and this is the log normal diffusion that you see that everybody talks about. You can see everything in numbers, in terms of numbers. There is simulation and there is also analytical calculations. Everything, we try to match everything so that, because people learn in different ways. If there are hurdles for you in terms of understanding a formula, then you go to Excel. See the analytical formula, see the simulated calculations, and they're all matched. So that gives you a comprehensive understanding, right? This is the diffusion of log of stock price. Log of stock price is actually normally diffused. It's already log of stock price. So that's why it's normal. The forward price dynamics, log normal. This is a martingale. You will understand all this. What is a martingale and all those things. And this is a stock price diffusion in 3D, right? You can see this picture. So essentially what this picture means is, in the beginning, let's say the value of the stock price was 90. So after 3 months, you would expect a log normal density around 90, but it will be concentrated because you have only given 3 months for it to diffuse. The more time you give, the more higher and higher dispersions you get. And the last one that you see here, this is obviously much more dispersed, which means the extreme outliers are more likely. After end of 1 year, you would see, $50 or even $200. So this is the log normal diffusion. All of these have, these numbers are linked to equations, so you can appreciate everything, all the moving parts. Okay, so we have everything in Excel. Also, you have everything in Python as well. So you have a formula, then in Python you just use that formula. It's not a big deal. So everything is clickable. So ultimately you'll be shared with this mind map and all the files, so you can just click through and come back. So these are the values we derived, right, in the Excel. $10.45, delta, gamma. Again, using the same closed form formulas, nothing else. But it's in Python. That was in Excel. This is in Python. Okay, let me close this. Now going back, let's talk about binomial tree. Once you're able to compare all these methods for the same set of values, you'll have an understanding like nobody else, right? And you are fully equipped to do anything you are asked to. Excel, Python, maths, anything you can do. This is a binomial tree with 9 steps, right? These are the initial parameters. 9 steps, call option, and the price is 10.64. We know binomial tree is not accurate. The more steps you get, the more accuracy you'll get. That's it. And yeah, by the way, whenever Karan and I develop Excels, we don't use constant values. We try to keep it dynamic. So if you put option here, you get a put option price 5.77. You can also play with the number of steps, right? So that's Excel, binomial tree in Excel. And we have binomial tree in Python. This is the function, binomial tree option price. You just put these values in the function, it gives you the answer. What kind of option? Number of steps, interest rate, sigma, initial stock price, time to maturity, strike price. This is the only extra ingredient you need. How many steps? Is it 2-step binomial tree or 3-step or 5 steps or 1,000 steps, whatever. Here are the parameters, and then you call the price. It's 10.64. Exact same implementation in Excel, same implementation in Python. Right? And then you can calculate delta, gamma, vega. So all I'm doing is for delta, see, shock the spot price minus the old option price with the original stock price divided by change in stock price. Just calling the function 2 times. That's all. With the shocked underlier, the original underlier, take the difference. That's the change in option price divided by the change in stock price. That's delta. Similarly, there are formulas for gamma, vega. Also, you can do the same thing, shocking the sigma. Theta, for theta, I'm shocking the time to maturity. For rho, I'm shocking the interest rate. That's all. And here are your values. Okay, Python implementation. Now let's look at Monte Carlo. For Monte Carlo, again, we have Excel. By the way, this number of instruments that you're seeing, those are only a few, but in the actual course, you'll get a lot of exotics as well. Asian options, barrier options, how do you price them, how do you find sensitivities, everything, all the files you'll get. So here is the Monte Carlo option price. It's 10.8. So essentially you simulate, right? This is the equation that you use to simulate the option price. Here is Z. That is the only source of randomness. Z is the standard normal variable. And that's all. You keep start with the price 100, and these are the different paths that it can take. And this is expiry. So these are the different values of the stock price. So hence this is the payoff. If the strike price is 100 and your final stock price is 117, then your payoff is 17. Here the option will expire out of the money because 87 is less than 100. And you have a range of different payoffs. Then you take the average and discount that to time t equal to 0. Okay. Yeah, here I missed the discounting part. So probably we can do this minus times two. Okay, 10.16. That's the, so it's random, right? So if I press F9, it will generate different numbers. But you can see it's around 10.4, which is the, yeah, the closed form solution is 10.45, but it is random. If you use more steps, then you'll get closer to the analytical solution. Okay, so that's Monte Carlo. And same Monte Carlo in Python as well. Monte Carlo simulation, we have here, we have just a simple function, GBM, takes into account the initial spot price, risk-free rate, time to maturity, volatility, number of simulation, number of steps. These are the Monte Carlo specific ingredients that we need to give. And just five lines, that's all. And here are the parameters. This is the entire stock price grid that we saw in Excel, is in Python. And here are various simulation paths. I have plotted the first 100 simulations. And okay. And then you find the price of the option by inputting the various parameters. So for call option, it is 10.44. This is the Monte Carlo price. Okay, different model. Similarly, you can find delta gamma also using this Monte Carlo pricing engine. All you need to do is call the pricing function, Monte Carlo pricing formula, by passing a shocked underlier minus the original one, where you don't have the shocked. Then divide change in option price divided by change in underlier. That's give you Monte Carlo delta. Okay. And please remember, as I mentioned in the Monte Carlo simulation, this is important. You need to keep the random numbers the same. So you're pricing it twice, right? With the original stock price and in the new stock price. In both these pricing, you need to keep the set of random numbers the same. This will enforce that. And if you see the delta, vega, gamma are exactly very, very accurate. In fact, it's the same as the analytical solution. Okay. So that's Monte Carlo for you. And then finally, we'll look at finite difference. That might be new to most of you. Look at finite difference. I have, in fact, implemented finite difference in Excel also. Right. So as I was mentioning, right, you start with the Black-Scholes PDE, then you use finite difference to generate this equation. Okay, there is quite a bit of theory, nothing difficult. And then you find out this equation. So what you do is, you know the option price at maturity, right? If the, so let me show you. Here on the y-axis, you have different stock prices till 30. On the x-axis, I have different time coordinates, different time. That's what I was telling you, that this represents a space-time grid. In our case, you don't have space, you have stock price. So stock price, time, grid. In each of these cell, you actually have the option price. How cool is that? For different combination of S and T, you have the corresponding option price. How do we develop this grid? Start from here. You know this particular column because if the stock price is 30 and your strike is 10 and you are sitting at maturity, then it's 30 minus 10, 20, right? So at expiry, we exactly know the price of the option or the value of the option. From here, you start marching backwards. How do you march backwards? Using this equation. That's it. You keep marching and you arrive at time t equal to 0. This is the range of prices of the option today, time t equal to 0. In our case, the stock price is 12 today, right? So all you do is a lookup. Stock price is 12, option price is 2.49. That's all. All right. And you can see for the Black-Scholes closed form option price, if I use the closed form option pricing formula, it is still 2.49. And this is just a grid lookup that is also 2.49 right here. So this is fast and accurate. Okay. But the other advantage that we talked about, right? Where if you want to calculate delta at this point, how do you calculate delta? Well, you already have a stock price, option price for a shocked stock price. So from 12, if the stock price goes to 13, this is my option price. From 12, if it goes to 11, this is my new option price. You already have everything available calculated in the grid, right? So the delta value would be, you can calculate delta using 3 different methods: forward delta, backward delta, center delta. I'll tell you the center delta because that is most accurate. At this point, the delta would be this minus this divided by this minus this. Okay, 3.48 minus 1.5 divided by 13 minus 11. Okay, so basically you take the value from upward shocked point and the downward shock, take the difference and difference between these two. So if you use that, I just use finite difference, and that's coming as 0.99, which is close to Black-Scholes analytical delta, which is ND1, 0.99, 0.99. How cool is that? Right? So similarly, you can calculate theta also. For theta, you need to take this direction because this is time coordinate. So if time changes, how the option price changes. Okay, so that'll give you theta. Gamma also you can calculate. There is a formula for gamma. So that's how you can calculate Greeks and price of the option using finite difference. Same thing is implemented in Python as well. I'll just quickly show you that. You see the grid. So you can trust your eyes. Okay, we are doing things correctly. Otherwise, these things will not match, right? So here is finite difference method. And this is the grid. It is a little bit different in the sense that it is backwards. So 0 essentially means you're at expiry. Leftmost column means you're at expiry. Because if stock price is 20, the value of the option is 10 because the strike is 10. And from left you march to the right. This is called forward marching. And 1 essentially means the time to expiry is 1 year. So this is today. Okay. So this is today's price, the final column. And you can see for 12, stock price equal to 12, the value is exactly 2.49. Remember these were the same values in our grid in Excel. Okay, so that's the implementation of finite difference in Python. That sort of brings me to the end of my presentation today. That's all I had to cover at a high level. I know it was a lot of information packed into the 1 hour, but slowly and steadily you'll climb through all of these components at your own speed and master the topics as needed. But my intention for today was to tell you that valuation of derivatives is a very, very complicated affair. If you are exploring on your own, it will take many, many, many years to master it. At least today, you have the whole big picture at your disposal, right? And you will never be lost. You know which component affects what component, where you are right now, where you need to go. That was my main intention. And yeah, so the intention is in next 2.5 months or 3 months tops, this entire grid will be complete in form of these different resources that I'm talking about. You'll find all the theory notes, question answers, Excel files, and Python files for each and everything. Okay, so yeah, and this is for valuation. Similar kind of a page we'll have for counterparty credit risk exposure modeling for different instruments. How do you draw the exposure profile and calculate EE, expected exposure, and potential future exposure? Okay, so everything will be clickable. You can click on theory, question answers, and Excel as well as Python files. All right, that's all I had. Now, if you have any questions, let's talk about that, but let me stop the recording. And thank you so much for your time.